when you're looking at alpha generation, what is it that drives that? Is it initial position building? You've got conviction-led allocation during corrections, or is it disciplined profit booking? Also, which part of the investment cycle is more difficult to execute consistently as far as you're concerned? From a funder as well as a technical point of view, is it the entry or the exit when it comes to those decisions?
So, in terms of alpha generation, I think it depends upon the style. But particularly if we talk about Technofunda, entry, we know what are the good quality stocks. We get even ideas around what is moving in the market, what sectors are moving in the market. But the real alpha is actually generated when we ride our winners and when we allocate more to the winners. So, yes, of course, entry and sector identification plays a very important role. But in my view, at least my style, I've seen that if we are able to ride those winners, those 20% of winners will ultimately create 80% of the portfolio returns if we have done it well. So that, in my view, is a true alpha generation potential which we can explore.
So I'll take the second part of the question, which is more difficult. If you look at the entry part is more a problem of plenty because you have 2,000, 3,000 stocks. But when you look at the exit, in your portfolio, you will have 20, 30 stocks. So that's not a problem of plenty, but that's a problem of attachment. Because when you're buying something, you are not attached to it. Once you have held it for 3 months, 6 months, you have got attached to it. So the first part is more a selection problem. The second part is more a behavioral problem. My personal experience, academic theory is easy to fix, behavior is difficult to fix. So more it's the sell which is difficult because your own behavior and attachment comes to it. And that is why, both Vivek and we are more proponents of, system-based investing, scientific investing, because that is where a system comes and it helps you to overcome your behavior. So yeah, sell is little bit more difficult because of the behavioral aspect of it.
In your experience, is wealth creation in a stock a one cycle opportunity like what these detractors would think, or is there still juice that you can still milk? I want to ask this question to Vivek.
Awesome. So the approach which I follow is called core and satellite. So think about core is like your long-term compounders which can have a very fairly big cycles, and we need to appreciate that the world is cyclical. Everything is cyclical. Just like how we get young and then we age and then ultimately we also have kids and they again grow. Everything in the world is cyclical, whether it's economy, whether it's interest rate, for that matter, even the demographics. So the core side of the stocks has a longer cycle, which means, they might be staying in a cycle for like, let's say 10, 15, 20 years. And then ultimately they also degrow and there is some kind of disruption in those companies also. And then other part which we play is more like satellite. Think like emerging players, like one is basically Virat Kohli and Sachin Tendulkar, who is very consistent, but someday even Virat Kohli and Sachin Tendulkar has to leave the pitch and they need to retire. But imagine, these satellite are more like Sanju Samson, right? Where they are just emerging. You see some kind of sector tailwinds. You see that company is entering into a new segment. And that cycle can go on for like 2-3 years, 4 years, and then it may die very quickly. And it also depends upon the sector. Like let's say consumption is more structural sector versus let's say sugar or metals is a more cyclical sector. So in my view, you can actually play both. We need to identify what is the game which we are playing. So if we are playing for long term, we need to play more of structural cycles. And if we want to play more of, medium term, we can play satellite stocks. And the best part about satellite is, that this thing will happen again and again. So you can actually play it every 2-3 years and you can make money out of it if done in a right way. Again, as we discussed earlier, entry and exits are most important there. In core, you can have slightly delayed exit, slightly lackluster behavior. But in satellite, you need to be extremely in an alert mode because things can go wrong also very fast. And that cycle can turn very fast.
Great. Saurabh, when you're looking at a sector and when there's a question, is this sector going through a re-rating or not? Or is this a short-term tailwind that is helping out? How do you make that differentiation? What are the technical factors that you look out for when the question of whether a sector is going through a re-rating or not arises?
So from a framework perspective, when we look at it, there are certain things which are common, irrespective of whichever sector comes, these are common. When you look at the institutional money flow, that's a common pattern. If it has to perform, the results have to validate it, that's a common thing. If you go through con calls, and not only con calls of exactly that sector core companies, there could be companies which are generating 20% revenue from that sector. Even those con calls, they're talking about more money flow, more business coming. So these are the 3-4 signals which are like common signals. Now there are certain signals which are more sector specific. So these are the 3 signals which you can cover through technicals, fundamentals, results, con call tracking and all. And now with the age of AI, a lot of this information can be churned in no time. The second is more sector specific. Like if you are looking at structural story which are going through regular cyclic turns like a auto. Auto is a structural story, but it will go through cycle. You have to look at the industry data. Versus something like what is happening, what has happened in defense. And I miss defense. Vivek picked defense really well. But with that learning, I picked shipping. So it's a public sector. So, here you have to also pick what the government is telling. If you have heard Modi ji's last 1 year of speech, in many of the speeches he has spoken about the shipping sector. So you have to also look at IOC, whether you are targeting a private sector company, public sector company, which is the trigger point and what the trigger point is telling. And then beyond that, you have to go a little more deep. Like signals like when public sector companies don't do con calls. Now there are companies who never did con calls, who never did investor presentation. They start sharing investor presentation. They start doing con calls. So these are softer signals. So it's a blend of these common and not so common sector specific signals.
You want to add something to this? You want to add something to this conversation?
Yeah, so I think here almost similar, but along with this, we also look at what is the delta that is happening in terms of the profit pools. Many times the profit pools suddenly shift to a sector, like what happened recently in the world of AI. So if you see, the profit pools have suddenly shifted to a sector where they were not existent, right? So if you can identify, some of these tailwinds where profit pools are generally emerging, that could be a great opportunity to also take care of.
Vivek, let me come to this question, because this is something that the market generally faces, and this is something that I have noticed quite closely, even when the whole insolvency trend was happening. At that point in time, there were a lot of stocks that were available for much cheaper price than what they used to command some time back. How do you, or what are the signs that you look for to ensure that we are not going to get ourselves trapped in a potentially weak company? And this is sort of the price correction is essential, and it's not optical.
Right. So I think, I've been through this. So basically, it's about many times value traps and sometimes just time correction kind of journey, which we go through some of the quality companies also. So the way to tackle, I've made all these mistakes, by the way. So initially when I started my journey, a lot of places I got stuck. Sometimes we are not ruthless in selling also. But one of the rule which I have made is how we can get into a company with a tracking position. So this is the method I follow all the time, that I don't want to put full foot in the door. Like I just want to take a small tracking position. I don't want to get in fully. I just want to get there, test the waters and see how it is performing. And many times, that has saved me of big mistakes, because if I have just allocated 1% into that company and that company doesn't do anything for like 1 year, my money is not getting stuck there. But at the same time, where I am right and the story actually plays out the way I have played out, I've thought of, then I can actually keep on increasing my allocation. And here again, there is a lot of dilemma. As a lot of us think about how easy or difficult it is to buy the same company at a higher price, right? So imagine we entered 1% at 100 rupees, and then now the story is playing out. The price has become 150 rupees, and then it becomes 200 rupees, 250 rupees. And taking the decision to actually add more at a higher price is very counterintuitive, because we are used to Amazon sale and all the things which happens in the physical world, and we feel that, hey, it's the same product, why I'm even buying at a higher price. It's very psychologically counterintuitive. But that is where what Ben Graham said, price is what you pay, but value is what you get. So if the business is really performing, the value of the business is actually getting better and better. And that somehow, prevents us from these kind of value traps. So we are not stuck in one company. Even if we are stuck at a very small allocation. And then ultimately, it might happen that even best of our conviction, the story has played out. We thought it might play out even further, but it has, for whatever reason, stopped playing out. It might be disruption or competitor coming in, or it could be, the sector tailwinds itself has gone. That is where, again, having that ruthless exit system from technicals becomes very, very powerful. So your value, what you are determining to add on different prices is fundamentals, and then you blend your exit system to say that, hey, now probably market is right. At least I want to get out right now. And if I am correct, I can always re-enter again. And that again is psychologically very difficult, because something which you have entered at 100, sold at 1000, to get back again at 1500, it feels like, I already sold that company for 1000. Why am I buying at 1500? But then we have to remove that anchoring bias if we want to avoid these kind of traps. So this is hard way I've learned it, because in my journey I've done so many mistakes, and then thankfully now there is a system in place.
Can the stock pickers here learn it without making those mistakes?
Yeah, so there were some of the stocks, guys, where promoters were excellent. The company was in a very niche market. Competitive advantage was amazing. It's like a monopoly in that industry. And we thought, it's a great company to own. And then I just sat in that for almost 3 years and nothing happened. And then I realized, there is a lot of value in the company. Management is great. The valuation is great. But there is no growth. The promoter was 70 years old and he did not have any aspiration to grow. There was no second generation looking after it. So that one point, that led to a very stagnant growth in that company. And I was just hoping and did not get out. But after, we refined the system and we blended more technicals out of it, that thankfully has got sold. So now even if that situation happens, I'll not be big, in that position. I'll be very tiny allocation inside that company.
Okay, that's I would say that's smart. Actually, that's the best way to be.
Thank you.
Saurabh, when you're looking at a stock that has entered your coverage universe or has become sort of part of your watch list, what is it that usually leads to that? Is it something business specific has happened? Some major order has come in? Has management commentary improved? Is a new buyer has entered the picture, or is it more capital allocation signals? Are you looking at any other factor when you actually add that stock to your list?
So the question is on the concept of idea generation, what we look when we are generating idea. I think it's a very probabilistic way of thinking. Let us say, I'll give you an example. Let us say there are two stocks. In one stock, you had a great price volume action, but not so good result. In second stock, you have great price volume action, good results, and promoter is also buying. So first stock, you have only one thing getting ticked. In second stock, you have three things getting ticked. So it's a mix of all. The idea is if there are 8 or 10 things which are important for a stock to move. A good sector performance, a good market. First, the market is like the ocean. The ocean has to flow in the right direction. Then the sector has to flow in the right direction. Then the company has to flow. Then the numbers have to come. And then after all that, there has to be demand of the share. If there is no demand of the share, if somebody in promoter is selling, keep selling, it will not go up. So there are multiple factors which impact the price. Some are short-term factors, some are long-term factors. When most of those factors are aligned, that is where you have highest chances of stock moving. So for me, the way I have scaled it, I have a system for technicals to see in terms of demand supply. I have things to look in terms of fundamentals. I have things to look in terms of con call sentiment and also in terms of demand supply of share. When more and more things get ticked, that is where I put more effort because the probability of success is more there. And historically also when you backtest your data and look through experiments, where more of the things are getting ticked, your probability to success increases. So that is how you look at it. So any day if I have a stock where promoter is also buying, valuation is also attractive, technicals are also looking good, bottom formation is also there, the sector is also doing good, any day I'll give more weightage to that as an idea.
You mentioned about a company that you liked and for 3 years nothing actually happened, right? Let's assume that there is such a company that one is looking at a given time. Fundamentals are great, management is great, everything's looking good sectorally, there's no major issues that are happening. but the price is way lower than what is the 200-day moving average. How do you explain? How does an investor explain it to themselves, rationalize it to themselves, why this divergence exists?
Yeah. So I'll first walk you through the framework because that will be very useful to the audience also. Like what generally I look at picking core stocks in particular. Satellite, the starting point is more of, price volume action, and then we want to go deeper into the fundamentals. But on the core side, there is a framework which I use being a mechanical engineer. It's called machine framework. And if all of you want to take notes also, you can take it, which is like, M stands for mega trend. So if there is a lot of long tailwinds, I want to first have that filter, because if that tailwind is not there for many years, I don't want to get in. The second is very important, which is called action or demand. Okay. And that is where this question is also connected. See, it's like, think about this. This is BKC, and let's say there are 10 apartments, buildings are there in a row in the same lane, and everybody has priced in, like let's say 60,000 rupees a square feet hypothetically. Everybody has the same price. Now think about it. Out of those 10 buildings, which building people will go in first and book the flats? Most likely, because they have limited money and in BKC, what is the price of a flat. So they want to get the best of the flat for that their budget which they have. So most likely they will enter into a building which is probably the best one. And if you see out of 100 people, 80 people are choosing building number 1, that tells you something about that company, that probably there is something really interesting about that company. So in market also, all of us have a limited capital, right? Whoever, even a biggest mutual fund, they have a limited capital. So if the fund is moving towards a particular company, we want to pay more attention to it. Now, the scenario changes only when there is a market correction. Let's say a market has corrected 20% and this stock has only corrected 15%. Even though it is below 200 DMA, I want to still look at it because that has outperformed the market. There is still strength in that company. And if you see a recent example, right, all of you might have gone through the Trump thing, what happened in Iran war and everything. If you see during this entire war scenario, power sector was one which did not fall much. And when market shorted up, this sector was bouncing the strongest as a sector, right? So we want to probably look at the strength. And then, of course, the other parts of the formula is like C, which is competitive advantage, whether there's something differentiated about the company. H is like high ROC, which you have already mentioned in the question. Then I want to see improvements in the company, what the company is doing to grow further. N is something new, what they want to do. And E is execution capability of the promoter. So sometimes it can happen that the sector is moving, the company is very good. The tailwinds are there, everything is in place. Like even capital markets industry, right? How many people would have grown a company like Groww? All the tailwinds were there, right? But the speed at which execution happened, that also matters a lot. So we want to holistically look at it, but demand is one of the very critical points. So the answer is yes, if the market is strong, I don't care about 200 DMA, I want to go with the strongest one. But if really the market has gone down, then I want to see the relative performance. But I never go when it is underperforming the market. I let them be in my watch list, monitor them, and then enter into it. And those who are interested, there is a detailed video also I've done on this machine framework on my YouTube channel. So you might want to check it out. Yeah.
Check out his YouTube channel for sure. There's a question for both of you. So if there is that divergence between price action and fundamentals, and it lasts for a long period of time, long in my head is like 6-8 months, right?
Yeah.
Which is the factor that you would pay more attention to?
No, I'll still wait, put it into my watch list basically. So I want to see some kind of demand coming in that. So my thought process is very simple. That if this is a really great building, in that BKC, and if nobody is right now coming in, I want to at least see some confirmation that, okay, somebody has now started paying attention and now started coming in. So I don't want to be the earliest. I want to enter optimally and then ride it fully. And even if I want to I'll take a small tracking position and wait for it to form a new high. Because if something really good is there, it is too good to be true, right? That nobody's entering there. That's my view.
I will add a little bit to it because we follow, though our core principles are same, somewhere in our philosophies and market caps we differ. So technicals works very well above a certain size. But let's say if you are playing in a sub 1,000 crore market cap, and for me that's a big arena, ultra small caps. There are few people like even the current market I'm telling. If you trade for 40 to 50 lakh rupee in some of these 1,000 crore market cap funds, you can take it 5% up, 5% down. So when few people have capability to move the stock, that is where you have to be little aware of technicals.
Correct.
So it is also important to look which segment we are playing. And one more factor, if we know why there is a divergence, like maybe there is a big guy who is selling. I'll give you example, 2-3 years back, Greenply, Westbridge used to hold 8% stake. Every quarter you could see they're selling. So now I know the reason for the divergence. Then I know the moment they come to offloading their stake, the moment it comes to 1%, if they sell one more quarter, they will be out and then there will be no seller. That is what technical is all about. Yeah. So these are the places where we might look at divergence. We may or may not invest, but these could be some of the reasons.
Yeah, and that's a very valid point because a lot of users might not be using technicals prominently. So technicals doesn't work in a highly illiquid stocks and stocks which has very low market cap, because then the candles are formed by very few investors. So you need to know that the stock is very liquid if you want to apply technicals to any particular stock. Otherwise, ground level research for SME micro caps works the best.
I want to take one last question, and after that, I'll throw it to the audience. Whenever you're looking at a Technofunda investor, they're essentially running on two timelines. There's a fundamental thesis, which is a more long-term, which will play out over a period of time, versus a technical, which may, suddenly go up or down in a matter of weeks. How should an investor look at it? Sort of picking and their conviction when these two timelines don't really match.
So I would say this is a big myth, unfortunately, because see, we have seen traders who have been traditionally using technical analysis. And when we look at technical analysis, we always feel, it's like something which you can use for an intraday, or you can see a minute by minute candle. And that's why you see all the fancy screens and we feel like, oh, if it is a trader, and there should be candlestick chart and it should be like tick by tick moving. And we need to be in front of screen if we need to use technical analysis. But what we do is, in core, we use monthly charts, which means once in a month the candle gets formed, right? And in satellite, we use weekly charts, which means once in a week the candle is formed. We don't even look at it throughout the week. And for core, we don't look at throughout the month. So many times, a good stock, which is a very good compounder, just for an example, no recommendation, like Eicher Motors or Bajaj Finance, those kind of companies which can compound for a very long time. If you just put it on a monthly chart, you will see like for a 10-year, there is an uptrend, there is no exit, right? So you don't actually need to look at technical analysis minute by minute, or if it falls by 5% or 10%, you should get worried about. It's about building a system and knowing why you are using technical analysis. What is your ultimate purpose to use technical along with fundamentals? So in my typical exit system in core, my technicals exits are around 20-25%, which means even for 1 or 2 quarters, a company is not performing well, I want to give that room to that company because I know that that company is following my machine framework. It's a very good compounder. It has a history of 10 years execution. I don't want to sell it with a 5% fall, right? But we need to understand why we are using technicals or fundamental. It's just a tool. It's just a way of looking at things, and you can use multiple time frames actually. So that is how we execute on both the sides.
You want to add something?
Yeah, and I think some of these things have to be decided as part of your buy thesis.
Yes.
See, you can apply a 20-day moving average. Like Vivek said, you can also do a monthly moving average and all. But let's take, like we were discussing just some time back, about the kind of growth mutual fund industry has done. 17% AUM for last 15-20 years and expected to do 15% for next 10 years. So when I'm buying, let's say, AMC company or like BSC, NSE, these kind of things, the thesis is, am I interested to play 10 years? Am I interested to play a market cycle which lasts 2-3 years? Or am I interested just to do a positional trading for 3 to 6 months? That thesis has to decide what has to be my technical parameter and my exit signal. Once that thesis is in place, then life is easy. Then you need to keep checking every 6 months or every 1 year. Has that thesis broken? Yes or no? If there is a structural disruption change, maybe you need to revisit. If no, then you go with your thesis.
Yeah. It's like, if you want to repair a computer, you will take a screwdriver. You will not go with a drilling machine, right? And if you want to put a nail, you will not go with a screwdriver, we'll need a drilling machine. So it's like about what tool to use how. That's what it actually means ultimately. Thank you.
Thank you.
Yeah. It's good.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.